Well, hey, everybody. Do you want to maximize your profit potential with options trading? Uh, Today, I'm going to share with you the three differences between buying options and selling options, and these are going to help you make informed trading decisions. When you're talking about buying options, you are gaining the right, not the obligation, to buy or sell an asset at a predetermined price, which is called the strike price. When you're selling options, you're taking advantage of receiving from the buyers, yes, and you're looking for market movement that's kind of a little more stable, not necessarily a lot or hard moving market movement. The first difference between the two of these, between buying options and selling options, is the profit and the risk potential. Profits. That's what we want to talk about. We always want to talk about the money. Let's talk about the money. When you're buying an option, you're basically going to pay a premium to buy that option. If price moves up, down in a steady fashion, then your profits are unlimited. They're infinite when you're buying. As long as the price is going in the direction you want it to go, then you're going to continue to make money. But if the price is not going in the direction you want it to go, you run the risk of losing the amount of premium that you paid. So your profits are infinite, but your losses are limited to whatever it is you paid for the options contract. As a seller, you're going to receive a premium. So that's a good thing. You collect money on the front side. It's a good way for you to generate consistent income. You kind of know what you're going to get with selling, right? So you collect your premiums, right, as a seller. And that's the max profit you're going to get. If you decide you're going to sell it for $20 or $30 or $100, then that's the maximum amount of money you're going to get. But your loss potential is, or your risk potential is, the amount of the spread or the amount of the collateral that you had to put up for it. So if you were selling something and you were doing a 1.5 strike, let's say, and that's going to have like maybe $150 of collateral. If it does what you want it to do, then you'll keep the premiums that you received. If it doesn't do what you want it to do, then you're going to lose the collateral that you put onto the trade as a seller, and or you're going to be forced to perform the obligation you said you were going to sell. If you said you were going to sell a call, you're going to be forced to release the shares at that price. If you're going to sell a put, you're going to be forced to receive the shares that you were going to get in this in that particular trade. Difference number two is directional outlook. When you're a buyer of options, you're expecting price to go. If you're buying a call, you're expecting price to go up. If you're buying a put, you're expecting price to go down. And it needs to keep moving in order for you to generate profits when you're a buyer. You have to be kind of correct on the direction, right? You don't buy and guess. When you're buying, you've got a pretty good idea of which direction it's going, or you think it's going to go, or you hope it's going to go. But when you're a seller, you don't have to be as clear on the direction. When you're a seller, the price can sit still. The price can move up a little bit. It can move down a little bit. It can move towards you, towards what you're doing, but doesn't breach your strike. And you're still winning. You're still going to be keeping the premiums that you received when you were selling. When you're a buyer, you need direction to do what you thought it was going to do. When you're a seller, directional bias is not as important. Difference number three is market outlook. Buying options is a way for you to gain leverage exposure to the underlying asset without having to pay the full cost of owning that asset. When you buy an options contract, you're saying you're going to get the right to manage or to do an option with 100 shares, right? If you buy them, you got to buy shares one by one by one. If you buy an option, a call option, you're believing price is going to go up. That means you've got the leverage exposure to 100 shares going up instead of just buying them one at a time. That's the difference for them. When you're selling options, though, it's often used when you believe the market is going to remain relatively stable, or move within a certain range. When you're buying options, you're expecting a much, stronger movement. When you're selling options, you're expecting price to just kind of stay stable, or at least to stay away from your strike price. Buying options costs you money. Selling options, you receive money. That's the major difference. I'm a seller coach. I believe that you do better in trading if you are a seller. You have the opportunity to win in more ways. When you're a seller, you can win if the price goes up. You can win if the price goes down. You can win if the price stays stable. When you're a buyer, though, the price needs to move in the direction. You only can win in one way when you're a buyer, because the price has to move in the direction you thought it was going to move. When you're a seller, the price doesn't have to do anything. It can just sit still and you can still be making money. Okay, so I've covered the three differences between buying and selling options. I want you to know, though, that listen. Options contracts is not for the weak and not for the faint. You need to kind of know what you're doing. You need to have a strategy, right? I coach strategies for sellers, ways that you can make passive income on a weekly or a daily basis by selling options in our community, Educator to Trader. You can go over there and check out what we got going on at Educator2Trader.com. Check the links in the description. I'll link everything we need to talk about down there. As a seller, we do covered calls and cash secure puts, and we do credit spreads. All righty. Both buying and selling options can be good ways to generate profits in the market or from the market. They both can work for you. You just need to understand what is your own risk tolerance, what is the market outlook, and what specific strategy fits your life, right? I've got a link in the chat with a questionnaire about which strategy is perfect for you. Everybody's different. We got different risk tolerances. We got different time in our lives. Everybody don't have time to watch all day. So you need to pick a strategy that allows you, that fits your life, basically. You need a strategy that fits your life. Well, thanks for hanging out with me as I talked about the three differences between buying options and selling options. Be sure to like and subscribe. Click the notification bell so you can make sure that you get all of our content. All right. Well, I'm Arlissa, Educator to Trader, and I want to tell you to stay green and let's get this money.